From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for June 6, 2025. Let's see what's happening around the town. Well, let's start with your Milwaukee Brewers. San Diego Padres are in town for the weekend, followed by the Braves and the Cardinals. That's a great week of baseball. And now for something completely different. At Discovery World, it's Turtle Fest. Everything you ever wanted to know about turtles, but were afraid to ask. And it's festival season, starting with Pride Fest and Tosa Greek Fest, just to name a couple. Let's start with a British Airways crew member who was discovered dancing in the business class toilet, buck naked. He was arrested on suspicion of being unfit for duty, you think? Here's something a little creepy and wonderful all at the same time. It was discovered that an 18-year-old Maryland girl had malignant tumors wrapped around her brainstem, and the condition surely would be fatal. Well, two neurologists at the University of Maryland devised an experimental surgery, and they successfully removed the tumors. That was the wonderful part. Here's the creepy part. They removed the tumors by taking them out through her eye.
Yeah.
We'll leave the rest to your imagination. And finally, a hungry wild elephant caused havoc in a grocery store in Thailand on Monday. The bull elephant, let's call him Dumbo, strolled in from the nearby national park and helped himself to snacks. It turns out he had a sweet tusk for chips and candy. When last we saw Dumbo, he was calmly grabbing more snacks for the road. Hey, Dumbo, paper or plastic? On the podcast today, we have Adam Bailey, Dave Sandstrom, Joel Driesing, and wrapping up the week, here's Kyle Tedding.
Well, thanks, Max. A pretty decent week for markets overall. The Nasdaq up 2.2%, 416 points this week to close at 19,530 on Friday. The S&P 500 up 89 points, closing right on the nose, just above 6,000, up 1.5% for the week. The Dow Jones Industrial Average up 1.2% on the week, up 493 points. Most of it coming on Friday to close at the week at 42,763 for the year. Dow back in positive territory, up 1%, including dividends. The S&P up 2.4% and the Nasdaq up 1.3%. You know, Joel, the week more or less got lost in terms of maybe some of the economic data amidst all the other news that was out there. But we really did have a fairly important week from a labor market perspective. It really kind of kicked off in earnest earlier in the week with job openings and ADP payroll report on Wednesday. But, I think the one that most people were eagerly anticipating was Friday's jobs report. 139,000 jobs added in the month of May, a little bit better than maybe anticipated, but some signs of slowing.
It's a little bit below the 12-month average of 149,000, but it was better than expected. And, the Federal Reserve has been saying that it wants a clearer sign that the labor market's in trouble before it decides to start resume its cuts in interest rates. And they're not getting it from this report. This report still shows that the labor market is relatively strong. That 139,000 jobs added in May was the 53rd month in a row that employers have been adding jobs. And we're seeing all sorts of signs through polls, through different surveys and indexes that consumers as well as business leaders are taking a wait-and-see approach on what they're doing just based on not being sure what's going on with tariffs and trade policies. And we're seeing that with employment, too. Employers are kind of holding on to the people that they have and not letting them go real quick. And part of it could be the fact, it's a demographic thing, but they could be afraid that they're back to where they were right after the pandemic when they let a lot of people go and they had a hard time getting people back, the ones that they wanted back.
Yeah, we did see some cracks this week in the labor market report, and maybe not necessarily an ADP version, but the private payroll version of it that came out earlier in the week where there was 37,000 jobs created on that report. But when you read through some of the footnotes, one of the things that kind of jumped out to me on that report was small employers, like the really small employers where they have less than 50 employees. They shed 13,000 jobs. So if there's anything that could be portend other issues in the labor market, we would probably first see it play out in the really small employers. And that came out in the private payrolls numbers, so more to wait and see. Certainly that's something that the Federal Reserve will look towards as kind of future clarity on what to do with rates and employment.
Yeah, Adam, even in today's report from the Bureau of Labor Statistics, I'm seeing things that we've been watching for a while. The number of temporary workers has been going down. It's 21% below where it was when it peaked 3 years ago when the Fed started raising interest rates to combat inflation. And that's usually a sign when temp employment goes down that employers are about to start laying off more.
Well, and we can look at the headline unemployment number at 4.2% and kind of pat ourselves on the back and go, well, yeah, everything's fine. The unemployment rate didn't jump, so what bad news is out there? But I think you both hit on some of the things that are a little more concerning. And in particular, Adam, your mention of small businesses. Well, okay, doesn't sound like that big of a deal. How many small businesses could there be out there? Well, a reminder that the vast majority of employees work for a firm that employs less than 50 people. Somewhere between 70 and 80% of employees are part of one of those smaller businesses. And so it is a big deal when small businesses start to lose confidence in hiring. They start to lose confidence in the direction of the economy because that is the heart and soul of our economic engine. And I think we lose sight of it when you look at maybe the billboards on this side of the road and see big names and big businesses. But it is still a country that is dominated by small employers. It's still a labor market that's dominated by small employers, and ultimately it matters. Joel, we got a lot of other data, manufacturing in particular, a big part of the reports this week. The ISM manufacturing numbers showing some signs of slowing there as well.
Right. That one and the ISM services, both of those are based on surveys, and both of those are pretty current. Both of those the surveys took place in May, so they're not as old as some of the reports that we got this week. And in both of those surveys, employers are talking about that uncertainty, that they can't plan for their businesses, they can't make forecasts for their businesses because they're not quite sure what to expect, for the tariffs and what, if any, sorts of effects those are going to have on their businesses.
Joel, I think you bring up a really good point as it relates to how the tariffs are kind of handcuffing not just business leaders, but also the Federal Reserve's actions. So you see some of these manufacturing numbers pointing to some slowing in the economy. And let's face it, we've been on a long expansion now. We're talking about since the pandemic ended, and we've had just tremendous growth in employment and in the economy overall. But it does put a lot of pressure on business leaders and on the Federal Reserve when they're trying to navigate these things with the uncertainty that is out there in the form of the potential tariffs and the trade wars that are going on right now. So I guess I would not want to be a Fed chair at this particular time.
Yeah, and get back to the two numbers, ISM services and manufacturing. What was interesting to me this week is now it's both of our pillars of our economy, servicing and manufacturing, showing contraction. And on the manufacturing side, the drop was the biggest we've had in 16 years. Granted, we've already been showing contraction in manufacturing already, but it was a sizable drop. And now paired with service sector just below 50, albeit like a tenth, just below 50, which is a signal of contraction.
Adam, the European Central Bank cut rates a quarter point this week, the 8th such move of the year for the European Central Bank. And amidst that cut, and then again with the labor market report today, Friday, we have a president that is insistent upon the Fed embarking upon rate cuts. And yet it seems like, at least for now, the economic data is, while certainly weakening and weaker, strong enough that Powell's been able to kind of kick the can down the road. And we saw rates jump a little bit higher this week as a result.
Yeah, I suppose that even though the president has been a bit browbeating Chairman Powell on lowering rates, his response is, not so fast. in part because the labor market is still relatively healthy, albeit signs of cooling. But we still have unemployment right around 4.2%, a sign of health there. And then inflation still is showing signs of being sticky and percolating a little bit in areas, and they're stuck waiting to see how tariffs really are going to play out in terms of lifting prices and inflation. Core goods, which have been a reducer, a detraction from inflation, at least in the last several months. Now you introduce tariffs on those core goods, it could reverse that trend and start to percolate inflation. And it's just too early to tell because a lot of the stuff that has paid tariffs on is on its way to store shelves for now. And we just really haven't seen it play out in consumer spending as of yet.
You know, Dave, we've talked for months about consumer sentiment and some of the other consumer confidence-like numbers showing that consumers just aren't terribly excited about the way things were shaping up, that they were concerned about the future, whether it was inflation, whether it was tariffs, whether it was any number of other things that had kind of percolated along the way. And then, you know, we got some data this week that it seems like investors are taking a page out of maybe some of that, those reports we've seen on sentiment more broadly, setting aside piles of cash, setting aside plenty of conservatism to their portfolios. You know, I really see that shaping up two different ways and maybe a little bit of both. One is, well, they're prepared for the rainy day that they think might be coming. But two is, it probably suggests that maybe despite some rallies we've seen, it hasn't been purely risk-taking that's driven that excitement. What kinds of conversations are you having with clients on maybe prepping for the kind of likelihood of some more uncertainty down the way?
Kyle, it's very interesting to see those cash numbers where they're at. I mean, in March we had the M2 money supply, which is really kind of counting up the money that's in checkings accounts, savings accounts, CDs, and other short-term instruments, money markets. And we hit an all-time record. I think it was in the low 21 trillion range. And I think it's a good thing to have when you see volatility like this, because you have people that are looking for deals. And as we saw following what is now referred to as Liberation Day and the subsequent two very, very violent sell-off days, that following Monday we saw the Dow open up 1,000 points up and lots of money coming in to gather up those discounted prices. So you're seeing the cash, I think, is an important part of a little bit of a safety net. It's always good to see the cash numbers being solid and healthy. I think it's smart for people to have dry powder in times of turbulence like this. And certainly for clients, as it relates to maybe individuals and their ability to spend and make sure that their short-term needs are covered, I think it's always a good idea during times of high and extreme uncertainty to maybe beef up your cash a little bit. Make sure that you got the next several months covered for whatever it is that you might need.
Do you ever worry that people are doing that too much, that they're getting too conservative? I mean, it makes sense that you want to, keep powder dry when you're uncertain, but
yeah, I guess it's you really have to take a hard look at what those needs are, Joel. And to your point, yeah, you can overdo that, I think, and it's a conversation is similar to the typical fear and greed factor, right? If you get too fearful, you can do yourself some harm by creating a mountain of cash that you don't need in the short run. So that's why I say you take a real legitimate look at what those needs are going to be in the next 12 months and make sure that you're covered and you have that money in a place that's not going to get roughed up too bad.
Well, and I would add that there are things right now that look attractive, but that maybe not quite cash, but that are safer overall. You need only look at the rate we can get on a 10-year Treasury bond right now at 4.51% as of the end of the week. Adam, something you and I look at quite regularly. The earnings yield on the S&P 500. What can I get a dollar put into the S&P? What can I get in earnings from those businesses versus a dollar put into something like a 10-year Treasury bond? Well, as of the end of this week, with forecast earnings on the S&P, $269.65 for the next 12 months, that puts a forward earnings yield on the S&P 500 at 4.49%. Adam, you tell me what's bigger, 4.51 or 4.49?
bonds are offering a whole lot more competition to stocks these days. And you don't always see it that way where the yield on 10-year Treasury is north of the earnings yield on the S&P. But what would you rather have? The consistency of 4.5% from a Treasury, or if you go a little bit further out on the credit curve, you can get high-quality short-term corporate bonds for just a little bit north of that, or the earnings yield on the S&P 500. And I think that's one of the reasons why there's so much cash on the sidelines and raising some more, because cash is offering a competitive return. A competitive return these days on cash is somewhere around 4%. You can get a Treasury at 4.5%. And I think it shows investors that there are opportunities out there to grow your money that are not always stocks. You look back over the last 15 years, if you wanted to have a meaningful return, you had to have a lot in the way of stocks because bonds and cash paid very little. Well, when the facts change, strategy changes with it. And I'm more content to hold a little cash. I'm more content to have high-quality short-term bonds at 4.5%, 5%. They're offering competitive returns to stocks these days.
And I would also encourage people that are in the higher brackets income-wise to take a look at the municipal bond market. Recently they've been beat up on the price side a little bit, kind of maybe a little bit of a delay. Most bonds took their beating in 22 when the Fed abruptly raised rates, and munis held up a little better. Recently we've had some weakness there, but those yields are very competitive, especially if you're in the upper tax brackets right now. The after-tax yields are very compelling, and it's also another diversifier for your fixed income portfolio.
I think let's bring the conversation on allocation full circle, because with where prices are on the stock market, especially here in the U.S., where the kind of overall level of uncertainty is with respect to the path forward for our economy, I think it speaks to an investment plan that needs to think more broadly than maybe what we had the last 5 or 10 years. Some of that, certainly, the municipal bonds, Dave, or just bonds more broadly, Adam, as you point out. But I think then there's also a conversation that we've been having more frequently here on the role that non-U.S. stocks need to play. And especially as we consider a world in which global trade patterns are going to change, there are going to be new winners and losers. And, potentially, Adam, that means that the role that non-U.S. stocks play, which had been quite minimal for the better part of 10 or 15 years, well, all of a sudden, maybe it's a bigger part of the plan.
Yeah, there's a lot of opportunity out there in non-U.S. stocks. And gosh, I feel like I have been saying that for the last 5 years, but they're finally starting to have their comeuppance, in part because the U.S. dollar is falling. There's other pieces besides that. There's some very well-run profitable businesses that are just outside of the United States that historically, and especially in Europe, pay double the dividend rates than what we've been accustomed to here in the United States. And they're trading at reasonable prices. They're not in the nosebleed territory where some of the domestic stock market is here in the United States. They're trading at fair values with better dividends and more runway in front of them. And on top of that, when you pair it with a falling dollar, that becomes an enormous tailwind for performance on non-U.S. And that's what's been playing out this year.
And Adam, I think we're also seeing some more aggressive rate cutting going on in some of the international markets and central banks over there. And I'd also point to some pretty significant increases in infrastructure spending. Germany, known for their austerity in the past, signed into law not too long ago a $1 trillion spending package, which is unheard of for that country. So that looks forward to some pretty significant economic activity coming in areas of the world that have been slowing a little bit.
I think those are all perfect reasons why the opportunity set, while it may not look quite as rosy here in the U.S. as prices are higher, as we have questions on kind of where things are headed, why for investors there's still a lot of ways to participate, to find opportunity as we look to the future. With that, we enjoyed doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.